joined by Monserrat Colín, tax partner at business advisory and accounting firm J. Del Rio. Monserrat, thanks for being here today.
Hello, happy to be here.
Can you first outline the conditions of the OECD's two-pillar plan for international tax reform and explain how the organisation can apply it across the 130 plus countries that have already signed up?
Yes, what we have in Mexico is, I would say, recommendations by the OECD. And we have there will be considered a meeting between the G20 and the OECD to deliver, I would say, like a type of master plan. And in this case, it's more focused on the Action 1 and Action 2 on BEPS. It is focused about the allocation of the profits between the different countries. It is also focused on BEPS, but it's trying to also consider a minimum taxation between the countries. So on Action 1, it is considered that the profits should be, I would say, allocated between the countries, but that could be taxable, not just in the country where you have a physical presence, but also in the countries where you obtain these profits. And the second one, the Action 2 BEPS, is more focused on a minimum taxation. So this minimum taxation is, I would say, this Action 2 and 1 and 2 on BEPS is trying to obtain more than 150 billions of US dollars per year, additionally to the taxation. So we're expecting on October 21 to deliver the blueprint, and this blueprint would give us, I would say, the chance to try to develop different rules on local rules and on the double tax treaties to maybe on the 2023 or 2025 to have a final documentation in Mexico.
And so, Monserrat, where would global companies pay tax under the new plan, and what would the tax rate be?
Yeah, the tax rate would be, we said this minimum tax is 15%, and it is considered to pay by the parent company. It is quite similar that the CFC rules, where the parent company needs to pay because of the taxes not paid by other countries. So we need to compare two things. The first one is the effective tax rate. We have a new calculation on this effective tax rate. It's not the one that we know. And we need to compare it with this minimum tax. And the difference need to pay by the parent company. So this parent company should be aligned with something which is called GLOVE. It's Global Rules to Avoid Erosion Profit. And we have two rules on this GLOVE. The first one is income inclusion rule, and the second one is undertaxed payment rule. So if the parent company is aligned on this income inclusion rule, is the one that needs to pay this different tax. And if the parent company is not aligned, we need to go with the following company in the group. So it's something that we need to consider. Imagine that in one country you have, for example, 5 companies paying, 3 of that companies are paying the tax on their proper way, on a higher amount, but the other 2 are not paying. We need to consider just for these 2 companies that are under this minimum tax. That's something that we need to calculate.
Monserrat, you're based in Mexico. Is Mexico planning any potential corporate tax regulation adjustments ahead of the arrival of the reform?
Yeah, in Mexico, we are always aligned with the OECD recommendations. So we are expecting that some of the recommendations are not just included on the double tax treaties, but also in their local rules. For example, in Mexico, we have some implementation in the last years, which is focused on companies that are pass-through entities, or, for example, in the application on double tax treaty to also consider just the benefits if both countries are able to tax in the both countries. So yeah, in Mexico we're expecting that the government include that in the local rules. Also in Mexico we have a tax reform. I would say a draft on the tax reform that should be delivered the next year. And we don't see any of this, I would say, minimal tax yet on this local reform, but we can see it maybe in omnibus tax rules, or in some other recommendations on the next years. But yeah, that's something that we will see.
Okay, perfect. And then obviously there's still a while to go before any tax reform takes place. But what are the steps that you would advise companies in the nearshore to take ahead of the implementation of these tax rule changes?
I believe we have a lot of work to do The first one is we need to make, like we said, a plan, an internal job between the different companies on the group. So nowadays we have, I would say, cross on information because of transfer pricing. We said information on the master plan. We have this cross of information, but at this point we need to be aligned on the accounting between the different countries because this effective tax rate that we need to, I would say, to calculate should be aligned on all of the countries. So in the accounting thing should be aligned between all the countries. We need also to see what kind of credits do we have, for example, NOLs. Because at this point it is not defined yet if we could apply these NOLs between, with the tax that we need to pay, if it is the case. It is also not considered what should be considered as paid, because we can pay, for example, 1,000 cash and the other amount maybe with a credit or with another kind of payment. So we need just to be aligned between the different countries. We need to have clear information. We need to align the accounting, and also we need to try to not allocate the profits in countries with a low taxation, because it worked in the past years, but at this point it is not something that's going to work. A lot of countries are trying to be aligned with this income inclusion rule, with these globe rules. So we need to try to allocate the profits where the work is done, and we need to pay the fair tax. That's not something that we need to do. It's a lot of work, but we just need to see what is the master plan, not just in that country, but also the master plan between all of our countries, and to try to make some, I would say, projections